Hey everybody, Joe here from Avalon. In this video, I'm going to outline one way that corporate business owners can use life insurance as a tool to reduce tax, increase value, and get access to retained earnings on a tax-efficient basis. Now, I'm not an expert on insurance, so I'll be walking you through just the basics of this strategy, but we'll be hearing also from our guest financial planner, Lane Cuthbert, later on in this video. He'll take us through an example of how this tax planning strategy actually works in practice. So all that and nothing else coming right up. First up, we'll do a quick intro to different types of life insurance. Term life insurance is one of the more common types of life insurance. It offers a set benefit for a set period of time, i.e. the term, for a fixed cost, which is called the premium. The most common terms are 10 years, 20 years, and 30 years. Another less well-known type of insurance is called permanent insurance, or sometimes referred to as whole life insurance. Whole life insurance provides insurance from your current age up until age 100. What makes this type of insurance unique, however, is that you're allowed to hold an investment inside the insurance policy. Now, without getting too technical, the rules allow for an investment to be held within an insurance policy as long as it doesn't cross above the MTAR line or MTAR line. And because Paul wanted to see if I could say this without stumbling, the MTAR line stands for Maximum Tax Actuarial Reserve Line. In broad strokes, it's a federally mandated line that distinguishes an investment from an insurance. The limitation is put in place because holding investments inside of an insurance policy is a tax-efficient strategy, and the tax man wants his cut of the investment proceeds. So what type of returns does an insurance policy get? Well, there are several different insurance companies that offer these policies, but they generally fall into these two main categories. Number one being participating policies, and number two being non-participating policies. Surprise. In a non-participating policy, the returns are fixed at 5% for most companies. In a participating policy, the returns can often be higher because the participating part means that you're a co-op owner of the insurance company. And unlike other passive income earned in a corporation, the investment growth inside a whole life insurance policy does not affect the small business tax deduction. So the investment held in your policy can grow tax sheltered without being counted towards the company's passive income limitations. So now that we have a better understanding of how whole life policies work, here comes the fun part for business owners: corporately owned whole life. Insurance policies can be taken out on anyone with their permission, of course. So a business owner can use these policies as a tool to leverage retained earnings in the company for a multitude of different purposes. It starts with a corporation owning a policy, i.e. the policy owner. That policy is taken out on the life of a business owner, the life insured, so that the corporation would use corporate dollars to pay for the insurance policy. While these premiums paid are not tax deductible for the corporation, they are usually still typically only taxed at the lower corporate tax rate compared to the business owner's own personal marginal tax rate, so a much lower rate. Once the corporation starts paying premiums into the insurance policy, the investment portion of the whole life policy begins to grow. This is from a combination of deposits and investment returns, and the balance is called the cash value of this policy. The cash value acts like equity in your house. As it grows and becomes more valuable, it can be used as collateral for a loan. In our example, the owner of the company is also the life insured, so they can use the insurance policy to collateralize a loan, which can be used on the personal level. And the business owner can maximize the efficiency of this kind of strategy by repaying the loan with the death benefit of the insurance policy. It's kind of morbid, but a lot of tax planning is. When done correctly, this offers another fancy perk known as the capital dividend account credit. A little known stipulation of these policies is that when the proceeds of an insurance policy flow through a corporation or are paid out to an orphan or a widow, the corporation receives a credit in their capital dividend account. The CDA credit amount is equivalent to the death benefit of the insurance policy, which means they can liquidate and withdraw corporate dollars tax-free using their CDA credit. So what does this all mean for business owners? Well, here's Lane with a demonstration of how this strategy can work.
Thanks, Joe. For those of you who don't know me, my name is Lane Cuthbert, and I specialize in advanced insurance strategies that help business owners to reduce their personal taxes, increase the value of their business, and reduce the taxable burden on their beneficiaries who deal with the business after the business owner passes away. And one of those strategies is through corporately owned whole life insurance. So I put together an illustration. Let's take a look at it now. So in this example, we are using a female business owner. She's aged 40 and she's choosing to put $1,000 a month of corporate dollars into this policy. Now, there's a lot of information here, but the three bits that we really want to be paying attention to are the required yearly premium, the total cash value, and the total death benefit. So the way that we structure these policies is after the 20th year, no more money needs to be put into this plan. And the reason that we do that is because the investment portion is allowed to continue growing for the life of the policy without ever risking going over the MTAR line. And so this is what we're looking at in the cash value. We consider all of this to be the tax-free equity available in the policy. So as this value increases, it can be used to collateralize a tax-free loan against the equity of this policy. Now, this business owner can retire really whenever she wants, but let's fast forward and say at age 75, she decides to retire. Well, at age 75, she would have $785,000 available tax-free that she could use in this policy to collateralize a loan and be put towards her retirement, towards investing in another business. Really, the options are endless. And the reason that banks will do this is because this policy costs nothing on a monthly basis. And as long as the business owner passes away in the future, the death benefit will always be higher than the equity value. So let's fast forward a little further and say at age 88, this business owner passes away. And let's say that she timed her passing perfectly and spent 100% of the equity that was available in her policy. So say that she spent all $1.4 million of the tax-free available money. Say she spent that. Well, that's okay, because when she passes away, there would be a $1.7 million death benefit that pays out. And that money would be paid to the corporation. Now, this is where we want to be very careful. We don't want the money that gets paid out to go directly to the bank and pay off the loan, right? What we want to do is the beneficiaries would then put up some collateral. So the bank is satisfied, but the business owner still owes $1.4 million. But we want the proceeds of that life insurance to go directly to the beneficiaries. The beneficiaries would then use the $1.7 million, pay back the loan, the 1.4, right? Now they're debt free and they're left holding a couple $100,000. Now, the reason that we did that is because when the proceeds of life insurance get paid out to a widow or an orphan, it means that the corporation would receive a credit in their CDA account equal to the death benefit amount, which means that the beneficiaries could then liquidate assets and withdraw retained earnings from the corporation up to the credit maximum of $1.7 million. So if that money is available in the corporation as they go to liquidate the business and shut it down, they would then be able to take out another $1.7 million tax-free. So that means the beneficiaries are now holding approximately $2 million tax-free, and that's after the business owner spent 1.4 while she was still living. So that's a total benefit of $3.4 million. Now, if you think that this example is a good fit for you, you need to talk to the professionals at Avalon, because understand these are extremely rough numbers. So do not hold me against this. If you want to know an example for yourself, I'd happily put something together for you. But at age 88, the approximate total tax savings by using this strategy is approximately $766,000. So like I said, you should always consult the team at Avalon. But if you think that this is the right fit for you, let us know and we'll happily put together an illustration that's custom tailored to yourself. So I'll pass it back to Joe.
All right, hopefully you've learned something new about the benefits of using insurance through a corporation to add value to your business. It's definitely an advanced tax planning strategy, so we recommend connecting with a tax accountant as well as an experienced corporate financial advisor before getting started. For some more common tax planning strategies, check out the link below to our video on that subject. And for more helpful content about building a thriving business, you can always subscribe to this channel. But thanks for watching, and we'll see you in the next one. Cheers.